All right. Thanks for joining us today. My name is Steve Romagna. I'm with Romagna Wealth Management. Today I'm joined by Tom Fellhofer, Fellhofer CPAs here in Menomonee Falls, Wisconsin. Tom, good afternoon, good morning, just right before noon. Good morning to you today. How are you doing?
We're doing great. Thank you for inviting me for this, the opportunity to talk about taxes.
Yeah, I mean, it's a popular discussion here at the end of the year. Tom, tell me a little bit about your practice here in the Falls.
So our practice started back in 1995. We do accounting, taxes, and payroll for small businesses, and we have many, many individual clients that we do tax work for. We do take on new tax clients all the time, and we're looking forward to this presentation.
All right, sounds good. So today we're going to discuss maybe some things to think about before the end of the year. I mean, we're coming up real close. We're recording this video early in December, but December 31st is a deadline for many tax moves to make. And so let's just kind of dig in and see what we got. The first one is capital gains loss statements. What do you have here for us, Tom?
Sometimes our clients will be coming in with 1099s for their mutual fund distributions, and they might be surprised at how much money their mutual fund has made over the years. They do have to pay taxes on that money reported, even if they haven't physically received the money and it's just sitting in the account. The 1099s that they receive might include municipal interest or qualified dividends, which get taxed differently than ordinary dividends. I will also say now is the time of year, if you have investments with losses, you may want to talk to your broker about doing some tax loss harvesting on those. But again, it's got to be an investment decision and not just purely a tax decision.
Yeah, no, I agree. I always tell clients that, this is that one kind of wild card every year. You don't know what you're going to get in capital gains distributions. They can vary widely. And it could have a very large impact on your taxes. Some years there could be very little capital gains distribution, a couple $1,000. One year it could be $40, $50, $60,000, and it could push you into a higher tax bracket. So it is something that you definitely want to keep an eye on. And even if you don't sell the fund, and you mentioned this, Tom, and I think this is smart. Most people might not realize this, but even though you don't sell the mutual fund, but by law the mutual fund is buying and selling stocks inside of that account. They might have a stock that they bought 5 years ago that they're selling this year. So by law, you have to pay the taxes on that, even though you didn't take any money out of that fund. And so it's kind of sometimes it's a surprise to people, like you said, and they might get hit with a little bit higher tax bill that they're not expecting. So definitely keep an eye on the statements. I think don't wait until you get your December statement because it's too late. If you have mutual funds, you can contact the company and they'll tell you what their estimate is and when they're going to pay that capital gain. But it's something to be, definitely aware of. Next one is fund your retirement accounts. What do you have here for us, Tom?
Well, depending on your situation, you may have one or two of these different retirement accounts, either a 401k or a simple, or maybe even a Roth IRA. The funding contributions change year to year. It's good to take a check at the end of the year here to make sure you've maxed out your contribution to your retirement account if you can. And also, we all get older, and if you're past 50, there's an extra amount that you can contribute to your 401k or your IRA. And then the dates that you need to do your funding differ depending on the type of plan you're working with. The IRAs are by April 15th to get your money in. And if you have a SEP IRA, you actually have until the extended due date of that return, of your return, to get that money into the SEP IRA.
Yeah, so this one might not have a deadline of December 31st to fund it. Some accounts might need to be open by December 31st, not necessarily an IRA, but some accounts, on the simple plans and things like that. But there's many different types of retirement accounts. It's something that if you're looking at, you obviously want to get some advice on, I think. But there's the IRAs, there's the Roth IRAs. Most of those have the limit of April 15th to fund those. Next is 529 accounts.
529 accounts are probably the most overlooked tax strategy. If you are planning for your education or your children's or your grandchildren's education, you can put money into a 529 account for their education, and the money would grow tax deferred. You don't get a tax federal deduction for it, but you would get a deduction if you use the state plan. Like if you're in Wisconsin, if you use the EdVest account, you can get a deduction on your state tax return for that. If you contribute more than you're allowed to contribute, the extra amounts carried forward and you get the deduction in a future year. So it's actually a wonderful way to fund education for the future, and get a tax deferral on that earnings that grow within the account.
Yeah, and I would even tell you, if you live in the state of Wisconsin, you should be using, either the EdVest or the Tomorrow Scholar Plan, and getting that benefit of the deduction. And even if you set that plan up in a different state, because every state has their own 529 plan, but to get the deduction, it's got to be set up with the state of Wisconsin plan. And if you're not utilizing that, I think that's definitely something that you want to take a look at. The other thing I would say is, now that they've given us it used to be if there was money left in these accounts, what do we do? What if they don't go to college? What if they get a scholarship? Now with the Secure Act 2.0, they've given us a provision that says, hey, if there's money left in these 529 accounts and you want to give it to the student, you can let them roll it into their Roth account. And so I think that's a pretty neat thing to do.
Mm-hmm.
RMDs. This is a very big topic here. Lots of different subjects here, but we're talking about required minimum distributions from your IRA. We always use the term RMDs. I think sometimes clients don't understand what RMD means, but it's just required minimum distribution. What do you have here for us, Tom?
Most of the time, when you reach the required age and you're taking your RMDs, most taxpayers know to take that money out, or their brokers telling them how much to take that money out. Occasionally, we'll run across somebody who's forgotten to take that RMD, and there are stiff penalties by the IRS for missing that RMD. It's just something you want to be aware of and use your investment advisor or your tax preparer to make sure you're taking your RMD. If you have multiple IRA accounts, you only need to take the RMD for the total value of your IRA accounts at the end of the prior year. Just know you need to take one RMD, and you don't need to take an RMD from each of your IRA accounts.
Yeah, no, that's good advice. I mean, we sometimes have clients that, it just makes sense, instead of taking it out a little bit here, maybe one account's doing better, or it's got a better interest rate or whatever. If we need to take the money out of here to satisfy the RMD somewhere else, we can do that, and that's a smart idea, I think. The other thing I would say is these rules are very confusing because they've changed in the last couple of years, and they continue to change, and they continue to evolve. Some clients, still think the age is 70 and a half. That was the law a couple of years ago. They've been slowly raising that age. Currently, it's 73. I think that age is going to get pushed back to 75 eventually. But right now, it's if anybody that's over 73 has to take this required minimum distribution. There's lots of different rules there about the first year RMD. I would just urge you to get some help and advice on this. And then there's also rules when you inherit an IRA, and depending on when the person passed away, under the old rules, or under the new rules say you have 10 years to take it out. Very complicated. I would certainly get some advice because, like you said, Tom, if they don't do it right, the penalty is pretty severe.
Mm-hmm.
Okay, next option, and this kind of dovetails in with the RMDs and giving money to charity, either just outright or giving it through the QCDs. What do you have?
Well, I really love how Wells Fargo uses the QCDs and records it for their clients. QCDs, qualified charitable distributions, can really save you a lot of money on your tax return used correctly. It takes some planning. You do have to set it up prior to making the charitable contribution, but it's very simple, and it's a huge tax savings for people that aren't itemizing anymore because of the raising of the standard deduction. We've found that this is the area, QCDs, that's benefit our clients the most over the last couple of years. I will also mention, given the recent change in the tax law, there's going to be an above-the-line deduction for charitable contributions starting in 2026. So even if you're not itemizing, tax preparers should be asking you, hey, did you make a charitable contribution? Even if you're not itemizing, you could get that deduction in 2026. And for the state of Wisconsin, we still get that deduction on the state return. So even if you're not taking an itemized deduction, keep track of your charitable contributions.
Right. Yeah. Maybe some people might not have been doing that because they weren't itemizing, right? But now this year, with the passage of the new tax bill, you might want to keep track of that. We do a lot of the QCD stuff here. I think it makes a lot of sense. The rule of thumb I use for clients is maybe if you're giving more than $1,000 or $1,000 or $2,000 to charity, and you are required to take money out of your IRA, then I think I would certainly look at this strategy of QCD. If you have to take money out of your IRA and maybe you don't necessarily need all that money or want all that money or want it from a taxable income perspective, this is one way to kind of lower that RMD amount by giving that money directly to a charity. And so the way we do it here at Wells Fargo is we give you a checkbook that is tied directly to your IRA so that you can just write those checks out to the charity itself. And it's a pretty neat way to do it and to accomplish that goal of maybe giving throughout the year. So we usually set it up with a client and come up with a kind of a projected amount for the year. We say $3,000 or $4,000, put that in their checkbook on January 1, and then they write out those checks. As long as it goes to a 501c3 organization, it qualifies, and then they get to use that on their taxes at the end of the year. So it's a really cool strategy, and I think it's an underutilized strategy, and I think it's something to definitely take a look at. And the other quirk I would tell you here is you can do this if you're 70 and a half. So, it's one of those things where I think they didn't change the age on this when they changed the RMD age to 73, so they left this at 70 and a half. So if you're 70 and a half, it might be a strategy to look at. It doesn't necessarily have to be at 73.
Mm-hmm.
And then here's a new one. This is one that you and I have talked about, Tom, that we think is kind of underreported. I don't think it's been talked about here in the state of Wisconsin, but this was a change that they made here in the state of Wisconsin. What do you have here?
Well, I think this is a big surprise for a lot of people that are retired. They're going to get $24,000 to $48,000, not subject to state income tax, if it's coming out of their IRA account. So this is a huge change for Wisconsin residents, a huge benefit, and I think a lot of people are unaware of it still. We've made our clients aware of it, but I haven't seen it advertised in the news.
Yeah, no, and I think this was one of those things that was passed this summer, and it was really, I think, what the thinking was here was, a lot of people would change their residence, right? They would move to, like, let's say Florida or Texas, a place that didn't have a state income tax, and they would change their residence. And so this is kind of the way of the state of Wisconsin to kind of compete with that and say, hey, we want you to stay here in the state, but we're going to give you this exemption on if you're retired and taking money out of your IRA. So I think it's a win-win situation for our retired clients.
Do pay attention to the age restriction. You got to be 67 or older, and you will lose your property tax credit, $300, but I guarantee you this will more than compensate for that.
That's good. All right. Well, I think that was the last one that we had for today. Any final thoughts on anything that we discussed today?
The one point I want to make is, people come to us and they want to save money. I want to save money on my taxes. How do I do that? Come and talk to your tax preparer early in December. Many times when you get to March or April, it's too late to make changes that might have benefited you. So plan ahead, get something done in December, and talk to your tax preparer in December so that you can lower your taxes.
Yeah, no, I think that's good advice. That's spot on. I always tell clients, you want to talk to your CPA, outside of the tax season, because in the middle of tax season, you guys are busy and it's hard to kind of, look at all these different things. But if you have time outside that tax season to kind of thoroughly take a look at it, and so I think that's definitely a good thing of advice. Not only the 5 things that we discussed today, but just have a discussion with your CPA. If you're looking for a CPA, give Tom a call, and we're here certainly to help too at Romagna Wealth Management. Reach out to us, and we're willing to take a look at your situation and see if we can help you out.
Thank you, Steve.
All right, Tom. Thanks for joining me today. I appreciate your help, and we'll be in touch soon. Thanks.